Hello everyone, myself Dr. Vinayak Gandal, and today we are going to discuss about income from house property. Friends, as you know that there are 5 heads of income, and whatever income, the income is chargeable to tax. So this is the second head of income, that is house property. And keep it in your mind, income from house property is chargeable to tax. So friends, before discussing about income from house property and how to find out taxable income under house property, we must know what is the income from house property. Friends, there are two types of incomes which is derived from the house property. One is rental income from house property, means if property is let out and if the owner getting some rent from the tenant, so whatever rent received by the owner from the tenant called as a rental income. And another is if property sold by the owner to the another person and if he get any amount of money as a consideration called as a sales proceeds from the house property. So these are the two types of income from house property. So but keep it in your mind, the income derived from the sale of house property is not treated under the head of income from house property because it is chargeable to tax under the head of capital gain. So rental income is to be considered in income from house property, but as per the Income Tax Act 1961, the rental income is not chargeable to tax under this property. So in the case of house property, annual value of this property is to be considered as a income, and that is to be considered for a calculation of tax. So before discussing about annual value and all these things, we must know what are the types of house properties. So friends, there are 4 types of house properties. First, self-occupied house property, means which is used for self-residence. Second is let out house property, means the house property which is actually let out to the tenant, that is called as a let out house property. Third one is house property used for own business or profession, and fourth one is deemed to be let out house property, means if a assessee or a person having more than 3-4 houses, in that case as per the latest amendment of income tax, only 2 houses are to be treated as a self-occupied and remaining are to be treated as a deemed to be. If property not actually let out but person is having a number of houses, so other than self-occupied house property, the other house are to be treated as a deemed to be let out property, and calculation is made as per let out house property. So friends, keep it in your mind, according to the Income Tax Act 1961, self-occupied house property is not chargeable to tax, means there will be no income tax on self-occupied house property, but there is a procedure to find out to use the specific format for the calculation of income or loss from house property. So house property, under house property, income is chargeable to tax and is based on gross annual value. So we must know how to calculate gross annual value. So the gross annual value is to be calculated by considering 4 types of concept, that is called as a municipal valuation, fair rent, standard rent and actual rent. So there is one format for calculation of gross annual value. So according to first step, we have to calculate reasonable lettable value, and that is to be calculated by considering municipal valuation or fair rent, whichever is more, but subject to standard rent. So least from these two is to be considered or treated as a reasonable lettable value. Second step is related with actual rent. Actual rent means annual rent minus unrealized rent. And the rule is, if actual rent is more than reasonable lettable value, then the actual rent is to be considered as a gross annual value as per step second. Third step is that if actual rent is less than expected rent due to loss due to vacancy, then gross annual value is to be calculated by considering that actual rent minus loss due to vacancy. So according to these three steps, we have to calculate gross annual value of that particular house property, and then as per the deduction under section 24, there are many deductions available under house property, but once gross annual value has been calculated, we have to consider municipal valuation, municipal tax which has been paid by the owner. If it is payable, then deduction is not allowable. Once municipal tax has been deducted, we have net annual value, and after net annual value, the deduction under section 24 is allowable. That is first deduction, standard deduction, which is 30% on net annual value. And once deduction under section 24, 30% deduction is been deducted, another deduction is available, that is called as the interest on borrowed capital or loan taken for the house property, either construction or purchase of the house property. So whatever interest paid is considered as a deduction, but in case of self-occupied house property, the maximum limit of interest on loan taken is rupees 2 lakhs, means not more than 2 lakhs is allowed as a deduction under section 24. If for example, if a person having a loan from any bank and he has been paid interest of rupees 2 lakhs 10,000 during the year, and property is self-occupied, then maximum deduction is a 2 lakhs, so he is allowable as a deduction under section 24, that is only rupees 2 lakhs. If property is let out, there is no statutory limit for interest on borrowed capital. Whatever interest is there is to be allowable as a deduction. So in the case of self-occupied house property, whatever interest we have been considered as a deduction, that is to be treated as a loss from house property, and whatever income derived from the let out or deemed to be let out house property, so after adjusting loss and income from the house property, we have a actual income from house property, that is called as a taxable income from house property. So these are the few steps. Orally I told some ideas about taxable income under the house property. If you have any doubts, you may ask me later. Thank you.